Hello and welcome to KYC. In this fast-paced world of stock markets, well, investors are bombarded with information about what they often lack is deep, comprehensive understanding of the companies that they invest in. Know Your Company is a show designed to give regular investors powerful, actionable insights into the fundamentals of a single NSE-listed company every day. And today we're talking about DCB Bank. This is a relatively smaller bank that has come into focus on the back of earnings today. So let's take a look at this particular bank. Well, it was incorporated back in 1995, so it's also a relatively younger bank as compared to many others which have been around. It's into the development of cooperative banks too, or rather it has moved from a development cooperative bank to a development credit bank. And moving on, it's in terms of how the product mix pans out, it does get about 45% of its product mix from mortgages. It's followed by agri, as well as incorporating banking. That's about 25%, and then the balance comes from SME and MSME, as well as co-lending, gold loans, commercial vehicles, etc. Now that's as far as its mix is concerned. But what we usually do with all companies that we take up on this particular show is talk about several parameters and also rate the bank, rate the particular company on these parameters with respect to a thumbs up, thumbs down, or a neutral rating. And among these factors, what we also do is, well, talk about the income statement, the balance sheet check, operational metrics, as well as asset quality. Moving on in terms of shareholding valuations along with street credentials and street coverages, the other factors that we take a look at as far as this bank is concerned. But let's start off with the one which is right at the top of our list. And before I bring all these parameters in, let's get in my colleague Harsh Sata, who's also going to help us further bring in more insight with respect to what the bank has done so far. So Harsh, thanks for joining in. And as usual, let's start off by addressing the income statement. So how does it look?
Well, yes, thanks, Agam. Let's start off with how the income statement is adding up. In that sense, and you'll have the net interest income number come right on your screen in a minute or so. The growth, the 3-year CAGR on the NII has just been 14% but it's a fascinating manner in which this PNL is stacking up, and that's what I want to really highlight. You look at operating profit, it's actually declined when you're looking at it FY21 versus FY24. So you've seen a decline on operating profit. That's because the OPEX within the bank has spiked and materially spiked up. It's doubled from sub 900 crore odd. It's gone to nearly 1500 crore plus in FY24. And that's where a large part of the leverage has been lost. But where has it gained leverage? With regard to provisions. Look at the provision number, 446 crore for FY21. It's come down to 142 crore in FY24. So there's been a sharp decline where provisions is concerned. And therefore, you're seeing that 17% growth on the profit after tax front. It's a completely mixed bag in that sense, because you're seeing top line growth on a low base, not going up in a material fashion, just about a mid-teens kind of growth. Profit growth also in the mid-teens, but your OPEX spike is what has led to that operating profit being absolutely flat, and then you've got credit costs which have come off. So a neutral on this one, because it's just such a mixed bag in the sense, in the way in which the income statement is playing out.
Sure. So we're going to give this a neutral rating as Harsh, and the reason why Harsh, explained, but we talk about the balance sheet as well. At least as far as the advances and deposits are concerned, we're looking at a pretty steady 17% CAGR for advances coming through, and deposits also growing, mostly in tandem with the advances at around 18%, so when it comes to the 3-year CAGR. At the moment for FY24, the advances stand at a little less than 41,000 crores, and deposits stand a little over 49,300 odd crores. So on a pretty stable footing, which is why we'll give this a thumbs up. In terms of its capital adequacy as well, that stands at around 16.3%. So it pretty much adds up to what we have seen so far. But let's talk about a handful of the other key operating metrics. Harsh, so what do you have for us there?
Well, yes, again, very, very interesting, the way in which it's panned out. Let's talk about yields first, yields on loans. They've crept up by just about 30 basis points in the last 3 odd years. Mind you, this is a cycle where rate hikes have started to come through, and therefore that just not enough meaningful increase in terms of yields is how I would term it. You look at cost of funds, in sharp contrast, it's gone up by 1% or thereabouts over the last 3-year period. Your margins also have largely remained steady till FY24, but after FY24, by Q3, we've seen large margin dilution. Look at your cost to income, and this is where some of the metrics which you saw in your income statement also come to light. You look at 49% was your cost to income in FY21, 64% in FY24, currently sitting at 63%. They're tapering down on their cost to income, but just by a wee bit. Therefore, ROAs, which have not gone above the 1% mark in at least the last 4 years, sit at sub 0.9%. But what is the one positive that I take from all of these numbers is there's a steadiness to it in that sense. ROAs have not gone down materially despite OPEX spike. They've been able to manage provisioning along with the OPEX spike to some extent in this cycle, and you're seeing ROAs sitting at 0.9%, leaving very, very low margin for error where provisions is concerned, but you're still able to maintain that steadiness with regard to ROAs, and that's the key positive I take from it, and therefore largely a neutral bag again on this one when it comes to the operating metrics, Agam.
Okay, so I'm going to talk about the asset quality, and perhaps I'll also bring in Harsh to give his perspective on asset quality itself. So when you consider the gross NPA ratios, they've certainly come off from the mark of, well over 4% to around 3.19 back in FY24, and as of the third quarter, that stood at around 3.11. So we are certainly seeing a decline in that gross NPA ratio. Net NPA ratios again would at the mark of around 2.29% back in FY25. This has come off substantially and halved to around 1.04 back in FY24, and at the moment again we're looking at a little bit of an inch up in the third quarter of FY25. But Harsh, the reason why we're giving this a neutral rating is because even on an absolute basis, these are still relatively higher NPA ratios.
Correct, and they've not come off materially, right, Agam? You look at it, it was roughly 4% in FY21.
Yeah.
You've seen some of the banks really double down on that gross NPA ratio. DCB hasn't been able to do that. And when you're seeing FY24 versus Q3 FY25,
yeah,
you're seeing a bit of a spike on all of those ratios,
right.
Especially on the net NPA ratio.
Yes.
And therefore, not sure whether that will sustain or not, and maybe management commentary will help there, and we'll take that. But at the moment, it seems like a neutral rating is better placed for the kind of numbers we're seeing.
Fair enough. So, and that brings us to factors beyond the financial statements. So we've spoken about quite a bit in terms of the balance sheet and the operating metrics, of course the income statement as well. But in terms of your shareholding, it's perhaps normal not to have such a high promoter shareholding in any bank or NBFC for that matter. DCB Bank is no exception, so it stands at around 14.7%. The institutional holding, however, does tend to be considerably higher than what DCB Bank has seen. So for the quarter ending December, its FIR holding stood at a little less than 11%. And it's certainly come off from the quarter sequentially. And it's the same for DI holding, that stood at around 27.9%. Usually, you tend to have a lot of these banks with a total institutional holding of well over the 50% mark. Considering that is not the case for DCB Bank is the reason why we're going to give it a neutral rating, because a large chunk of it is still with the public at large. So that's as far as shareholding is concerned. But how do valuations stack up, Harsh, given the kind of growth that we've seen? Yeah,
now I want to contextualize this a little bit. Why I'm giving this a thumbs up? Two reasons. One is you're seeing mid-teens kind of growth.
Yeah.
The growth over the last 3 years is sustained at slightly later teens, if I can call it, 17 to 18%, which is the one key positive. The other key positive is that you're seeing asset quality also hold up. Now you look at some of these banks where asset quality has been a challenge over the last 2 to 3 years, and you look at valuations and you'll see DCB Bank trading at least a 30 to 40% discount to all of them. In some cases, much more than that. And therefore, believe that at 0.64 times, DCP definitely looks like a decentish number in terms of where valuations is concerned, and therefore a clear thumbs up on the valuations front.
So there you have it. That's as far as your valuations go. And moving on, let's talk about street credentials. So how things are panning with respect to the stock itself and what it has done. If you just consider the last 12 months, it has come off by around 13%. If you consider the way your benchmark indices have moved, maybe if you can talk about the small cap and the mid cap indices, it'll give you a better picture, because I reckon that DCB Bank belongs to that particular group of stocks. There is still a positive return for both the mid cap and the small cap indices respectively for that period of the last 12 months, which is why we're going to give this a thumbs down, because it has underperformed at least the indices it is likely to be a part of. That brings us to the final one on what the street makes of DCB Bank. Now, Harsh has already spoken about relatively favorable valuations, and that perhaps also gives you an idea what the street may have made of it. So, Harsh, why don't you tell us that?
Well, yes, 20 buys and 2 hold calls on this one. And I'll talk about the upside, because that's really fascinating. A 32% upside from here. That would typically take the price to book closer to 1. It may not be 1, with a 32% upside. But this is again basis 1 year forward valuations of 0.64 times. A 30% odd upside would warrant around a 0.85 times price to book if that were to play out. And that's exactly what analysts on the street are also suggesting, that this definitely needs a bit of a re-rating where the valuation number is concerned, is what I'm seeing. This is, of course, as per Bloomberg analyst estimates, and therefore it's an average of all the analysts taken together. But let's talk about just a couple of factors before we wrap this. When you're looking at the way in which some of the metrics have played out, and Agam, I want to just delve on this a little bit further just to try and clarify our position here. You're looking at a mixed bag in terms of performance, and it's a very, very unique set of numbers that we've seen in the way in which DCB has played out over the last 3 years. You rarely see the kind of OPEX spike that DCB has seen. OPEX from sub 50%, cost to income has gone above 64% and thereafter tapered. We're seeing in this quarter specifically a flattening of sorts with regard to the OPEX number. Can that sustain is really the question that I would look out for. And we'll, of course, quiz the management on that as well. And the other piece which, I would be really keen to understand is how is all of this asset quality issue in the industry playing out on DCB's numbers, and what we can expect going forward, both in terms of growth as well as in terms of numbers on asset quality. Because typically smaller banks, the size of DCB, 40,000 crore odd in terms of assets, can grow at a far higher growth clip. Is there a reason why they are holding back, or can they now scale up on growth? Is a question that I would like to ask. But just some of those.
Yeah, no, actually, that's a very pertinent point, Harsh, that you made, because I was just looking at the size of the bank, and it's been around for a while. It's not, even in the listed space, it's been around for a while. And I know that it was incorporated just in 1995, but it still has had plenty of time to, consolidate and perhaps grow to perhaps a size that it may not be necessarily at this point in time. I'm just looking at the technicals here. I'm looking at the way the chart is coming through. And over the last 2 years, that is maybe a little less than 2 years, since April of 2023, the stock has continued to make, or rather take support at the mark of about 107, 108, 109 rupees per share. Currently, given the kind of market conditions that we've seen, it's not too far away from it. But I'd also like to point out that it's usually moved within a very narrow range between 100 to 130 rupees per share over the last, maybe 2 years. Notwithstanding a little bit of a sharper volatility that you see here and there. And of course, in the same period, it has moved up to about 162. But again, it's just something that, well, it's not seen a significant amount of appreciation. And I reckon that all the shareholders waiting by are possibly looking forward to, well, a jump in growth, especially, like while Harsh mentioned that you're looking at a mid-teen growth, for a bank of this size, perhaps investors are expecting a slightly faster growth coming in. So that's what we're keeping an eye on. But I just want to ascertain if we do have the management of okay. So we do have the guests with us, but before that, let's go across and take a look at the final rating on the several parameters that we have put through. So it's largely a neutral rating for the income statement. The balance sheet is again a thumbs up for sure. We have well, neutral to slightly positive ratings as far as the operational metrics is concerned, along with asset quality among the other set of parameters as well. Out of the 8 parameters, it does not have a thumbs down on anything except for street credentials, and that is basically your returns on the stock. Well, thumbs up certainly for valuations and street coverage, so that's something that we can keep an eye on as well. So an overall rating of around 5 out of 8. But let's get in the management. We have with us Praveen Kutty, who is the MD and CEO of DCB Bank. Praveen, good afternoon, and thank you so much for taking the time out. Praveen,
thank you for having me here.
Absolutely. Praveen, I actually wanted to start off by asking you about the expectations of growth coming in, especially when it comes to your net interest income as well as profitability. What can we expect going forward when it comes to FY26 specifically? So, more or less of what we've seen so far in the past 2 to 3 years, or can we expect an acceleration here?
So there are a few things that you'll see repetition of the past, and there are some things which you'll see change in the future. So one of the things from a repetition of the past is that if you were to see the last 5 quarters, we've been growing consistently around the 19 to 20% YOY region. I would presume that that will continue in the future as well. Having said that, there are some strong headwinds on the unsecured space, plus liquidity is getting tight. But I think we have the wherewithal to grow at these kind of, to repeat these kind of performances from a growth perspective going forward. So that probably will be the continuation factor. What will change and what we're really trying to make change is that earlier when the top line used to grow by 20%, the NII used to grow only in single digits. The last 4 quarters has been 4%, 5%, 7%, and now 15%. So one of the tasks before the management is to improve that and get NII growth very similar to the top line growth going forward. So there's a lot of focus going to be on that area. Plus, the kind of effort that you put on the fee line has started yielding some results. So look at the core fee income more than the total fee income. It's something which we are reasonably happy about. The cost discipline, we're tightening the belt a bit. And that is showing some signs, early signs. I mean, we'll see how the consistency of performance goes, will come through. And on the credit cost, which is the 4th parameter, in these troubled times, keeping the NPA stable is something which we are okay with, we're happy with. And possibly on a go forward sense, improving the NIM would be very high on our priority list.
Okay, Mr. Kutty, Harsh also joining in. First question on the margin. Hi.
Right.
So my first question is on the margin, because if you're talking about a similar growth clip on the NII as on the advances, the only way to do that is margins. But margins for you have contracted a wee bit when you're looking at it over the last 9 months, thereabouts, quite a bit there. What's happening there? And can we see it revert back to 3.6%, where you've been for quite some time?
It's a bit of an ask, but what we're happy with is that our descending, the reduction on NIM has been arrested. We have grown NIM in the last quarter, primarily on the back of yield and advances improving by a higher percentage than the cost of funds. We'd expected the cost of funds to remain flat, but that hasn't worked out. It doesn't look like it's working out in the future also. We're seeing heightened activity happening on the deposit market. So it's a bit of an ask, but we're very happy with the fact that we have turned the the direction, and work is underway to improve the NIM. I can tell you one way we will not be improving the NIM is by getting into unsecured loan, or that's not. We would stay within the framework that we have, the strategic framework that we have, which is holding us in good stead from a NPA perspective, and that within that framework we would see the growth happening. Possibly you will see the NI growth inching up to the top line growth by the second quarter of the next financial. So, like I said earlier, there has been a creeping up of the YOY. It's converging with the top line growth, and possibly the top line growth being equal to the NI growth, or the other way around. We would see that happening in Q2 of next year.
Praveen, can you give me an idea about what you can expect from maybe your gross NPA and net NPA ratios? While they have remained stable in general, there's a little bit of a sequential creeping up, at least not a sequential pardon me, but your net NPA ratios have seen a little bit of an up move when compared to the end of FY24. Your gross NPA ratios remain largely at around 3.1. What's the way forward here?
Our focus is on ensuring that we have better resolutions coming up and better slippages. For a bank which is primarily looking at secured asset, I think our slippage ratio is a bit higher than what it should be. So there is a lot of focus going into ensuring that the fresh slippage comes down. There are multiple reasons why the slippage is high. We are in the gold loan segment where discipline is not there. But frankly, all that I believe are just excuses. We have to better control our fresh slippage. So a lot of focus is going in there and on better resolutions. And frankly, considering the fact that most of the book is secured by self-occupied residential property, I believe that we have a good chance of improving our resolution rates as we go along. Having said that, the MFI, we have a small book of MFI. That doesn't augur too very well. I don't think we have seen the end of it yet. There are some pains coming from there. We can't wish it away. But since it's very small in the overall scheme of things, I still think that we should be able to keep a tight rein on the NPA ratios going forward.
Okay, I'm going to couple 2-3 questions together and put it across to you, Mr. Kutty. First one being on OPEX. OPEX has been elevated. Are you going to calibrate it back in this credit cycle? That's point number one. Point number two, do you expect this credit cycle to play out in a larger fashion over the next 2 to 3 quarters? Is it going to impact your numbers? And therefore, what should that do to ROA expectations? Would ROA take a knock for 2 to 3 quarters lower? Is Q4 that quarter where that will happen?
Let's talk about the cost to income ratio or cost to average assets. If you see, we are in the current quarter, we are at 2.59%, which is way better than the cost to average assets that we have achieved in the last 4 quarters. Definitely better than the last quarter, definitely better than each of the prior quarters leading up to the last year. There is if you were to see our staff cost, the number of staff has reduced. So there is a lot of focus on productivity, and that is giving us improved cost to income and cost to average asset ratios. On a go forward basis, our thrust is we are a very people driven bank. So it's very, very essential that if you have to get the ROA formula right, productivity has to continue in the same trend, has to continue improving on the same trend. So that's a key element of keeping in the range of cost to average assets. At 259, is that where we want to be? We probably want to be below 2.55. On the credit cost, we always have mentioned in the last, ever since the abatement of COVID, that the model supports a 0.45 to 0.55% credit cost ratio. We're currently at 0.38. Why we are at 0.38? Primarily because you're getting the benefit of higher provision on restructured assets, and the restructured assets are currently running down. It's just about 2% now. It is as high as 7 or 7.5% earlier. So that benefit will kind of erode over a period of time. Every passing quarter will be less than the previous one. And I would expect it to go back to the 0.45, 0.4 kind of credit cost on a steady state basis.
Okay, Praveen, we leave it at that. Thank you so much for joining us here on NDTV Profit. We look forward to the next set of numbers as well. Thank you so much.
Thank you for having me here.
Likewise. Well, on that note, we are at the end of this edition of Know Your Company, but lots more lined up on the other side. Stay tuned, and we will be back in just a bit.